If you're a high-income earner and you want to build wealth in the most tax-efficient way possible, you're going to need to know about 1031 exchanges. In this video, I'm going to show you why 1031s are one of the most powerful tools for growing your wealth and an essential tool for high-income earners who are looking to use real estate to shelter their income from taxes. Why? Because as a high-income earner, you have a lot of income to shelter and you're paying the highest tax rates. If you're earning $300,000, $500,000, or even over $1 million a year, here's what you need to know. You're not playing by the same rules as the average investor. You're playing by a different set of rules, one where the IRS has a target squarely on your back. You're not only paying the highest tax rates, many of the tax advantages that are built into the tax code are phased out over a certain amount of income, typically starting at $100,000. So you need a tax strategy that suits your income level. And most tax strategies out there just aren't going to save someone earning a high income enough in taxes. Let me give you an example. If you're earning $500,000 a year, do you think that a duplex you buy for $250,000 is going to create a big enough tax shelter to make a difference? It's not even going to make a dent. That's where 1031 exchanges and the right real estate strategy are essential. That duplex you buy isn't going to solve your tax problems. It's the next property you 1031 exchange into, or even the property after that, that's going to be big enough to shelter your income. Now, this all assumes you know how to invest in real estate the right way. Stick around because later I'll walk you through how we did just that, where we sold 3 smaller properties and 1031 exchanged them into a 32-unit property. We not only avoided paying taxes when we sold those 3 properties, the 32-unit created an $850,000 tax shelter. None of those 3 smaller properties alone made enough of a difference in our taxes, but this one 32-unit property was finally big enough to shelter our high incomes. So this is the key. You need to learn how to scale up to larger assets while using 1031 exchanges to do it in a tax-efficient way. And that's exactly why 1031 exchanges are so important. Let me run through the key points again, because if you're new to this, I know it can be a lot of new information to take in. 1031 exchanges are essential if you're trying to build serious wealth through real estate because, number one, taxes eat your profits. Every time you sell a property, you send a big chunk of money to the government. You not only have to pay capital gains taxes, there's also something called depreciation recapture. I'll show you an example later of how these taxes add up really fast. That's money you could have reinvested, money that could have gone toward the next bigger deal, money that could have been compounding instead of evaporating. Number two, if you earn a high income, small properties don't move the needle enough to make a difference. If you're earning $500,000 or $1 million plus a year, let's be honest, small properties aren't going to replace your income, and a couple $100 in monthly cash flow from a duplex won't change your life. To build freedom, you need to scale. And scaling requires moving into bigger properties, and 1031 exchanges give you a way to do it tax efficiently. Number 3, compounding is the secret to scaling. 1031 exchanges allow your equity to stay in the game and compound. Every time you sell and trade up without paying taxes, your returns compound and you build wealth faster. You're building wealth on top of wealth, deal after deal. And in just a moment, I'll show you 2 real examples from our own portfolio that prove how powerful this can be. These aren't hypotheticals. This is exactly how we use 1031s to scale our own portfolio. In one case, we had a single-family home that we were using as a short-term rental. It had appreciated nicely, but instead of selling and paying taxes, we did a 1031 exchange and rolled that equity into owning a significant portion of an 87-unit property. That's right, from one small property to a significant piece of a large commercial deal. In another example, we took 3 properties, a single-family home, a duplex, and a sixplex, and 1031 exchanged them into a 32-unit property. Not only did we avoid paying taxes on the sale, the bigger properties gave us meaningful cash flow, and we were able to take advantage of economies of scale that just don't exist with smaller assets. That's what happens when you use 1031s strategically. And if you're wondering how this works step by step, keep watching. In the next section, I'll walk you through 4 core rules governing 1031 exchanges and 1 big pitfall that causes most exchanges to fail. Let's break down what you need to know to use a 1031 exchange correctly and avoid losing this powerful benefit. Rule number 1. The properties must be like-kind. You're exchanging investment property for investment property. You can't trade a primary residence for a rental or vice versa. Both must be held for investment use. Rule number 2, don't touch the money. This is where many people go wrong. Once you sell the property, you can't receive or handle the funds. They have to go through a 1031 intermediary, someone qualified to hold and transfer the proceeds for you. Touch the money and the exchange is disqualified. Rule number 3, you have 45 days to identify a replacement property. From the day you close on the sale, you get exactly 45 days to identify your next property. That's a tight window, and it's where many investors panic and either fail to identify a replacement property or settle for a bad deal. To avoid this, my wife and I like to work in reverse. We find the larger property first, get it under contract, and then sell the smaller properties. That way, we're not scrambling against the clock. Rule number 4, you have 180 days to close. From the day you sell your original property, you get 180 days to close on the new one. The biggest mistake we see people make is selling without a solid plan for their replacement property, forcing them to rush into a deal they don't really want just to complete the exchange. So to recap, you can trade investment property for investment property. You have 45 days to identify, 180 days to close, and you must use a qualified intermediary so you don't touch the money. Now you might be wondering, what happens if I don't use a 1031 exchange? Let's look at that next because the cost of skipping it might surprise you. Let's say you skip the 1031 and sell your property outright. What's the impact? You'll owe capital gains tax on your appreciation, plus you're going to get hit with another tax called depreciation recapture. This adds up quickly and often takes a much bigger bite than people expect. Paying taxes every time you sell slows you down and prevents you from taking full advantage of compounding. Let's run the math using an example. I want to note that these calculations are highly simplified. For accurate calculations, please consult your tax professional. Let's say you sell a property with $1 million in gains. If you're a high-income earner, you're going to pay around 23.8% in taxes on the gain, or $238,000. Note that this is just your federal tax liability and doesn't even include state taxes. But for the sake of this example, let's say you're lucky enough to live in a state like Texas that doesn't have capital gains tax. On top of that, let's say you've claimed $1 million in depreciation while you own the property. You'll be faced with an additional 25% depreciation recapture tax, or another $250,000. So in total, your tax liability is $488,000. That's $488,000 you could have used to scale into your next property, generate more cash flow, and keep your wealth compounding. Now that's the power of 1031 exchanges. It allows you to defer the capital gains tax as well as the depreciation recapture tax. Hopefully when you see these numbers, you realize how critical 1031 exchanges are for building wealth efficiently. Want another example? Here's one we saw at a finance seminar that we attended. If you had $1 that doubled every year for 20 years without paying taxes, you'd end up with over $1 million. But if you paid 33% tax on the gain every year, you would end up with just $28,000. That's what taxes do to compounding. If you're earning $500,000 or $1 million plus a year, using 1031 exchanges isn't optional if you want to build wealth efficiently. It's essential. This is how my wife and I went from a few small properties to hundreds of units. It's how we built cash flow large enough to step away from medicine. It's how we bought back our time, raised our kids on our own schedule, and created a lifestyle that didn't depend on trading time for money. And here's the truth. It's not about owning a couple rentals and getting a little bit of cash flow. If you're a high-income earner, you need to scale up your rental business so it generates enough cash to replace your income and let you live life on your terms. So if you're a high-income earner and you're ready to take the next step, this is exactly why my wife and I created Zero to Freedom, our course specifically designed to teach high-income earners how to invest in real estate. In Zero to Freedom, we teach you how to find the right deals, scale up quickly, and use advanced strategies like 1031 exchanges so you can build a real estate portfolio that actually moves the needle. So if you're serious about buying back your time and living life on your terms, check out the link in the description below to learn more about Zero to Freedom. And if you found this video helpful, please hit the like, subscribe, and drop a comment below to let us know where you are on your investment journey. We read every comment and we love to hear from you. Thanks for watching. See you in the next video.